3, 2, 1. Start webinar. Wait for 2 minutes and then Ashish can. You are on mute, Ashish. Thank you.
Good evening, everyone. It gives me immense pleasure to welcome you all for this special online session on India Budget 2023-24. I, CA Ashish Subedar, welcome you all for this great evening. Before we begin this event, we would like to thank His Majesty Sultan Haitham bin Tariq, our sponsors CBFS, and our corporate supporters and corporate members. May I request all to stand while we'll play ICAI motto song.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
As you all know, India is celebrating 75 years of independence as Azadi Ka Amrit Mahotsav. So next 25 years, leading to 100 years of independence, has been renamed as Amrit Kal. This budget was special due to several factors. It was the first budget in this Amrit Kal. This was current government's last full budget before the next assembly polls. Before we start the proceedings of the day, I am very happy to inform you that Muscat chapter of ICAI has been awarded second best chapter in the category 2 jointly with Singapore chapter. We, the managing committee members, extend sincere gratitude to our members, past chairs, and ICAI leadership for the wholehearted support extended to us. Thank you everyone once again for your support. Now I request CA Gaurav to introduce our speaker, CA Ved Jain. Thank you.
Hi, good evening everyone. CA Ved Jain has been a man of prudence, genuineness, and intelligence since birth. Academically brilliant, he has been a rank holder in both CA Inter and CA Final. A triple bachelor degree holder, he completed his Bachelor of Science from Punjab University in 1973. And as a true follower of continuous professional education, after completing his Chartered Accountancy in 1976, and for the love of the subject, he did his Bachelor's of Arts in Economics in 1979 and Bachelor's of Law in 1980. A prolific writer having command in 5 languages, Hindi, English, French, Urdu, and Punjabi, has authored many books on direct taxes and regular contributions articles on tax matters in various journals, newspapers, and frequently participates in various television programs on finance, taxation, economy, and related subjects. In the year 2008, he was elected as president of the Institute of Chartered Accountants of India, and during his tenure as president, ICAI earned various credentials which embarked a new era of education, training of students, and professional development for members. There were enormous list of achievements during his tenure, but I'll just mention the one which stands out from an international perspective, as he was instrumental in getting the Memorandum of Understanding with the Institute of Chartered Accountants of England and Wales recognizing each other's qualification, and also initiated the process of recognition of CA qualification with the Institute of Chartered Accountants of Australia and Canadian Institute of Chartered Accountants. CA Ved Jain has held various positions in various organizations, educational institutions, and corporates throughout his career so far. His integrity, zeal, and commitment towards the society has been recognized and appreciated by the Government of India. He is being regularly consulted and member of various expert committees panel constituted by the Government of India for fiscal and commercial legislations. His talent has been appreciated by the media as well. He is much sought after panelist by the media on contemporary issues, maybe it banking, capital markets, accounting, taxation, or corporate laws. We welcome CA Ved Jain for this special event of the Muscat chapter of ICAI on Indian budget. Welcome, sir.
Thank you, CA Gaurav. As Honorable Finance Minister Nirmala Sitharaman has said, there is something for everyone in this budget. So poor people get subsidy, middle class and rich gets a rebate, and CA people get debate. So let's start the debate on budget 2023. Over to you, Jain Saab.
Thank you, Gaurav, for that elaborate introductions. It's my pleasure to be here to deliver a talk on the budget 2023, the Muscat chapter of the Institute of Chartered Accountants of India. The chairman, the vice chairman, the office bearers of the Muscat chapter, and all my professional colleagues, brothers and sisters, I'm very happy to be here addressing Muscat chapter, a city which is considered to be the third most beautiful city of the world. I believe Venice in Italy and Lisbon in Portugal. After that, it is the third beautiful city of the world, and I believe the most beautiful city in the Middle East. This organized streets, coordinated lightings, elaborate spaces, tall palm trees, roses, greeneries, and very gentle breathing, seas and towering hills embracing each other's, which have fascinated so many poets and writers to write and be there. I had sweet memories when I came to Muscat, long time back, of course. And this time I also would have visited, but because of my compulsions, I could not come up to Muscat. But this new technology has allowed us to be so close to each other that we can be very close. Sometimes I wonder, the way we interact in webinar or seminar, we can see to each other sitting just like opposite each other, as against in a hotel and a conference room, where you have a distance of maybe 50 meters or 100 meters, you are just sitting across each other. And you being the ambassadors of the Institute of Chartered Accountant and the profession, I believe doing a wonderful job, bringing what I will say laurels to the Institute and to the professions. And my heartiest congratulations to the Muscat chapter for what I call getting this, the best prize, second best prize of the best chapter, along with Singapore. You have been doing a wonderful job. in the Middle East, and I believe the way the things are going on and the way the profession is growing, I believe you have many, many miles still to cross and work on this. Friends, we are in the year 2023. And the 1st February 2023 is a day in India to take stock of the situations and where we are, how we are doing, and what we intend to do. We all know from March 2020, for the last 3 years, the COVID has taken every country, every person in a manner that things were not normal, and many of the countries are facing great difficulties. But this time, the finance minister presented her budget in a situation where things looks to be almost normal. And she was quite confident the way we have worked and the way the Indian economy has performed. I hope you would have watched the program when she was presenting her budget. And it's more than 75 hours the budget was unleashed in the parliament. She has made a lot of announcements and a lot of things to do on the Indian economy. Indian economy has performed very well as compared to the other economy of the world. Indian growth, Indian working, and the way I believe India is going to perform in the next 2-3 years, things looks quite bright for that purpose. As was said in the beginning, this budget was a vision for the Amrit Kal, with the Honorable Prime Minister on completion of 75 years, laid down a plan for the next 25 years, because in the year 2047, we will be celebrating 100 years of our independence. And these 75 years are going to be the what called Amrit Kal. And in this Amrit Kal, there will be opportunity for citizens with focus on the youth, growth and job creation, strong and stable macroeconomic environment. Considering this, the finance minister made 7 priorities, which she announced Saptarishi: inclusive development, reaching the last mile, youth power, financial sector, infrastructure and investment, unleashing the potential, green growth. These were the 7 objectives and the what we're doing. And these objectives was, when we talk of inclusive development, which means sabka saath, sabka vikas. And all sector, whether it is agriculture, cooperative, building digital public infrastructure, horticulture, making India global hub for millets, starting up agriculture accelerator fund, targeting funding, setting up of widely available storage capacity, etc. These were all part of the budget, and she has worked it out away. An idea of India's reach out, I think, can be made out from this, that there is a more credit to the agriculture sector, and it is reaching 186 lakh crore agriculture credit, which is reaching it out. India will be having a record food grain production, which is going to touch somewhere 320 million tons. Just imagine. It looks to be maybe small for a country of 140 crore population, but still uses a number which has grown. We were having 250 million tons in the year 2014, and in the last 9 years or 8 years, I would say, we are now reaching 320 million tons of production. And what has been planned it out for inclusive development on health side, there will be 157 new nursing colleges to be established. There will be new program to promote research in pharmaceutical. There will be joint public and private medical research, as the Honorable Finance Minister said. Now the Indian Council of Medical Research Laboratories will be allowed to be used for private sector also to carry out a research opportunity for the year. And there is an increased expenditure which has been marked for health and education, substantially going up on this issue. Similar will be revamped teachers training, District Institute of Education and Training, National Digital Library, and the states will also be encouraged to set up physical library at Panchayat and ward levels. An idea of how big the Indian economy and how the expenditure has been incurred can be had from the fact that 220 crore COVID vaccinations were given to about 102 crore peoples. Just to see the volumes, number one. There are 47.8 crore Jan Dhan account, which cover roughly, I believe, 40% of the population of Indian population. Our GDP growth, which we look into this, can you just share the slide? I will just share the presentation. Can you go to the next slide? Now you see GDP growth expanded by 8.7% in financial year 20. The projected GDP growth for financial year is 7.0%. This forecast is in consonance with the International Monetary Fund projection of 6.1%. Similarly, the government has budgeted an increase of 12% in the net tax revenue. I will just share you later on the slide how our revenues have gone up, which show the indication the way Indian economy has been performing on that part. The GST collection, I hope you might all be getting the figure. We are crossing 150 lakh crores every month. So it is 18 lakh crore which we are looking into. Now when we see the policy announcement in the budget, which are saying skilling and education, corporation-led growth, ease of doing business, then we research and development centers, and then MSME revamped credit guarantee scheme, which has worked wonderfully well for India on that part. Now, this gives an indication that how Indian economy is going to perform in the years to come. An idea can be had from these figures. Our GDP presently is roughly $3.5 trillion. I hope you're getting this number four. Slides are clear if I'm saying?
Yes, sir. If you can make it in the full screen mode, it will be useful.
Yeah. Just a minute. That's why I asked. Can you make full screen? Over there. Full screen.
Sir, कुछ participants के सवाल आ रहे हैं, so we'll take it at the end.
Yes.
Yeah.
Now this is. I hope now it is better.
Yes, sir.
Okay. So if you see the fourth column is India. Now we are at $3.5 trillion, and we are going to reach $5.4 trillion in 2027. This is the India to witness a steady GDP growth. We know this issue. Sometimes people believe that 5 trillion, what is so big in 3 to 5? But one must appreciate from 3 to 5, it is 66% jump. And what will be the future? And today, average Indian income, what we call per capita income, is 1.97 lakh rupees. This is which gives you roughly 16,000 rupees per month. That's a number. Which, looking to the large population, it's a very impressive figures the Indian economy is doing and performing at it. And this, in comparison to others, if you look at the other number, 18 will go to 26, which will be 33% increase. And then France will go from 2.8 to 3.3, which will be just less than 20% increase. Germany will again be 4 to 4.9, just 20% increase. India will be going for 3.5 to 5.4, which is roughly 60% jump. Japan will be 4.3 to 5.2, again just 20% increase. UK will again 3.2 to 4.2. This may be something somewhere 40%. And United States 25 to 30, just 20. Of course, our base is low. That's why the number looks to be impressive. But the base of other countries also, France, Germany, Japan, Kingdom is also low. So that's why it's going to be very impressive economy. Why I'm sharing this figure is, you sitting in Muscat and Oman, you can just work it out that what great potential India has, and people who are sitting outside, can they afford not to make an investment in India? That's a scenario. If the economy is growing with economic stability, political stability, and best of infrastructure, is one of the best opportunity to make an investment in India. Now, this is the figure, GDP growth extended by 8.7%. So this is quad Q2Q, and this number, red number, is only an indication of the year when we had a COVID. So we have bounced back after the COVID like anything, and the things are going to be quite positive in the years to come on this issue. And this numbers gives another number, inflations. So now we see the Indian inflations have been hovering around 6%. Now, December 22, we are just working it out on that basis. So this is also again an indication that yes, India, as compared to your advanced country, European countries, America, others, our what we call is much better than the other countries on that. And this is what we are, and this is our subject also. Just look at the tax collections. Can you share that? Now our GDP per capita GDP next per capita GDP is 11.4%. Go back. And these were the period when we got affected because of the COVID 2021, but we have bounced back at 11.4%. An idea of the total tax collection, can you share that slide just? Yes, no. Just like revenue growth website. Okay. Now, this slide can give you an idea. Just look at, we are all accountants. Let's just try to appreciate this slide. The revenue collection tax next. Now, this is the slide which indicate that total income tax collection, which were 12 lakh, 44 lakh crore in 2014-15, has gone to 33 lakh 60,000. Just 3 times in the last 8 years. This is the figure which indicate the total gross tax revenue. And this is a figure number which indicate and where we will be. If in 8 years we have multiplied by 3 years, 3 times 12 to 33, I'm sure in the next 8 years, we will cross this what we call the 33 lakh 1,000 crore to 100 lakh 1,000 crore. That's a figure number which I look to in figures. Can you go back to the slides? And this is the projected tax revenue which we are working, and I believe that's a figure which we are next list. Now, having said so, I believe we will be more interested in what has really changed about the income tax and what has on taxation front, how does it affect on that part. For that, I will just take you back to the Parliament when you were there, when the finance minister was presenting the budget on 1st of February. And one thing which she did, and when there was a loud noise about the thumping of the desk, was change in the tax rates. Everybody was expecting that the tax rates are going to be changed, and there were a lot of expectation, but whatever her compulsion, but she has done a wonderful job by increasing the tax rate. And she is now under the new stream which she has worked it out. There will be no tax up to an income of rupees 7 lakh. That's a big change which she has announced on that. Can you take back the presentation? Now, what she has done, just let me make it out. She said there will be no tax on income up to rupees 7 lakh crore. Oh, so sorry, 7 lakh. So if you have an income up to rupees 7 lakh, there will be no tax. But at the same time, she announced that on income from 3 to 6 lakh rupees, there will be a 5% tax. On income from 6 to 9 lakh rupees, there will be 10% tax. And 9 to 12, there will be 15%. And 12 to 15, there will be 20% tax. And beyond 15, there will be 30% tax. So people are just wondering, when there is no tax on income up to rupees 7 lakh, how come this slab of 3 to 6 and 6 to 9 is working? How can there be? So we need to understand the nitty-gritties on that part. First, we must try to appreciate that this exemption of income up to 7 lakh rupees is available only to an individual, and that to a resident. Since you happen to be non-resident, this exemption up to 7 lakh rupees will not be available to you. This exemption is available to only a resident individual. And the reason being that slab will be 3 lakh rupees, 3 to 6, up a threshold 3 lakh no tax, 3 to 6, 5%, 6 to 9, 10%. But up to income of rupees 7 lakh, an individual resident will get a rebate in tax of rupees 25,000. There is a section 87A introduced in the income tax a long time back. Earlier, the rebate was 12,500, but now it has been increased to 25,000 rupees under the new regime, which is called the new tax structure. So any person who is a resident individual, he will get an rebate of rupees 25,000. So when we calculate this tax on rupees 3 to 6 lakh, 5%, 15,000, 6 to 7, 1 lakh, 10%, 10,000, 15 plus 10, 25,000. So if your income is 27 lakh and then your tax is 25,000, you get a rebate of 25,000, your liability is nil. But one thing one must keep in mind, the moment you cross 7 lakh, your income becomes 7 lakh 5,000, then this rebate will not be allowed to you. Then even resident individual will not get it. And with the result that in case your income happens to be 7 lakh 5,000, your tax liability will be 26,000 rupees. Now, how it will be? Just the rebate will not be allowed on 5,000 rupees. You will be liable to pay 10% tax of 500 rupees tax on that, and then 25,500 rupees plus 4% education cess. This is the change which we must appreciate. Then the second point is, for a salaried employee, a person who is getting a salary income, he will be eligible to claim a standard deduction of rupees 50,000. All employees will be eligible irrespective of the amount of the salary. There was a confusion amongst various people that this rebate of 50,000 may be allowed only standard deduction only to income up to rupees 15 lakh. This is not the case. This will be allowed to everyone whosoever has a salary income 50,000 rupees. With the result, a salaried person can get a zero tax up to an income of 7,50,000 rupees. Similarly, in case somebody is receiving a family pension, so there is another provision in section 57 which allows you a rebate of 1/3 of the family pension up to 15,000 rupees. So the income a person who getting family pension up to 7,15,000, there will be no tax liability. But one must keep in mind, the moment you cross this threshold, then the tax will start from 3 lakh rupees. Having said so, these are the things only for the resident individual. You being the non-resident, you are not in this scheme. But now the new regime says that the new regime will be applicable on all individual, all HEF, association of persons, body of individual, and jurisdiction person, and including non-resident individual. For you, it will be 3 to 6 lakh rupees, 5%, 6 to 9, 10%, and no exemption and no deductions. But in case you have an exemption and deduction, and because you will be eligible to claim under the old regime only, then the choice will be to go back to the old scheme rather than going to the new regime. By and large, for the resident individual, our arithmetic says that a resident individual is placed in a much better position under the new regime because he gets a deduction of but after paying the taxes on that issue. If an person falling in the bracket of 7 to 15 lakh rupees, he has to work it out which scheme suits him better, old or a new. Because if you know, under the Income Tax Act, if I simply work it out, what are the various exemptions available? Can you go to that slide, which are the exemptions? Just give me just a minute. Next. Okay. Next. Now, these are if you can just look at the slides, these are the deductions which are normally available. One is ATC up to 1,50,000 rupees. Then we have a special scheme of national pension scheme, which is available 50,000 rupees. Then we have a medical insurance, you can get a deduction of 50,000 rupees. So this is a 2,50,000 rupees. In addition, there is an interest 2 lakh rupees on interest payment or housing loan. Then you can get a saving bank interest 10,000 rupees. So this is 2,10,000 and this is 4,60,000 rupees. And for a senior citizen, because the interest on bank loan is a bank deposit is 50,000 rupees, you can get a deduction up to 5 lakh rupees. Now, these deductions will not be entitled LTA, house rent allowance, interest on education loan, donation to charitable institution, and donation to political party. This will all go. Now take a case. Can you go back? Just go back to the slide. Please. Can you go back? Next. Now take this case. Now this is the scheme where you are not having any what will be the difference under the old scheme or in the new scheme? This is the tax advantage one is getting under the new scheme where the new reduced rate has come. Now, this is the tax liability under the old regime and tax liability under the new regime, where you are not having any deductions, meaning thereby on 7 lakh, you are paying under the old regime 52,500, and now you will be paying nil to 52,500 is the advantage. Under the 9 lakh rupees, the advantage will be 47,500. On 12 lakh rupees, advantage will be 82,500. On 15 lakh, advantage will be 1,12,500. It will continue. And this advantage will continue on higher income, whatever you can go to next year. Now, this is another change which has been introduced is the rate in the increase change in the surcharge rate. You know that there was this highest surcharge of 37% on income exceeding rupees 5 crore. Now, this has been reduced to 25%, with the result a person paying under the old regime, under the new regime, the tax advantage will be just like this. Just look at 5 crore 25 lakh person will get an advantage in tax of 20,88,450. This is the biggest advantage which person is going to get. And if the income is 6 crore, then the benefit will be 23,69,250. And if the income is 10 crore, the benefit will be 38,66,000. This is a big bonanza, and the finance minister has taken a hit of 37. She has taken a hit of 37,000 crore rupees on this aspect, knowing that how it is going to work. Now look at what is her planning and how she is looking to Indian economy. She is looking to the Indian economy that making more money available in the hand of a common man or a taxpayer, it will increase purchasing power, and the more money coming into the market for purchase, it will give a boost to the economy. With that perspective, she is working on that direction, that a person who is having an income of say 10 lakh rupees, now he will have an additional fund flow of rupees roughly 3,50,000 rupees. He need not save the money, and on 10 lakh rupees, he will be just paying around 52,500 rupees tax. So 9,50,000 rupees is a disposable income available to the person, as against 6 lakh rupees, which used to be earlier. And this will give an additional fund in the hand of a person. And if I just assume, we have 7.5 crore taxpayer. And as per the statistics available, there are 5 crore taxpayer which will be falling within this income of up to rupees 10 lakh. And each person getting 3,52,500 as an additional money, assuming as a conservative that he spent or he invests somewhere, even he spent say 1 lakh rupees extra purchasing power on these 5 crore people, it will be 5 lakh crore, which will come into the market for increasing the purchasing power. That is going to be a big bonanza for the Indian, I believe, the economy, the way she is looking into the aspect also. But there is another aspect to also this. Since we are chartered accountant trying to understand the nitty-gritties, the larger question is, by encouraging people not to go for saving, whether it is justified or whether we are going into the right direction. Just look from the perspective, when a person makes investment in provident fund or public provident fund or NSCs or life insurance, he is creating a social security for himself. The government of a country of a population like India of 140 crore cannot provide a social security to all the person. It cannot make any money available to people beyond 60 years of age, as in some of the advanced countries, that when you retire, you will get something money, etc. Giving a 5,000 rupees each to a 60 crore population will be a huge amount which India can't afford. In lieu thereof, the income tax right from 1961 has been encouraging taxpayer. Look, gentlemen, government will not be in a position to create a social security, but we are encouraging you. You put some money in your life insurance, you put money in your PF account. And that's why the labor laws also say that when you get employed, the employer is duty bound to deduct some money as a provident fund. So create your own social security. But now with the new regime being there, the government is encouraging people not to go for making a social security rather than spend the money. This is a change in the thought process. When a person takes a life insurance, it makes plan for the contingency, something happen if to him, what will happen to the family. So that's a plan. Similarly, when we medical insurance, ATD exemption is given, it is basically to create a health insurance in the sense the way the COVID has happened, what will happen tomorrow from where the money will come. So that's an encouragement system. Similarly, the housing loan, etc. benefits are given for that purpose. But now I believe India is also going ahead in the what we call developed nations league. So they are thinking in that direction, let people spend more money and people allow people to spend more money. That is one the thought process which I believe has been created. Having said so, the another point to be noted, I believe, which will be applicable to you all, the new regime will be applicable by default, meaning thereby everyone will be considered to have opted for the new regime unless he specifically in writing opts for an old regime. So while filing the return, one will have to be very careful that whether he want to go to the old scheme or when a new scheme, because by default he has to be in new scheme only. So he has to tick it in case he want to go to the old scheme. And here in this case, all those persons, taxpayer who are not having business income, they can make a choice on year-to-year basis. It is not necessary that even in once you have chosen, you can continue it. This year you can plan, work it out the two computation, old scheme and new scheme, where you are benefit, you can work it out on that question. If you believe that your tax liability is coming low in old regime, you can go for old regime. If you believe that your liability is coming under a new scheme much better, you can opt it. So this option will be available to a person who does not have a business income. But a person having business income, this option of changing from old to new or new to old will be available only once. Having changed once, then you will not be entitled to change the plan. So for you also, I believe as a non-resident, you have to look into that perspective. I believe all of non-resident Indians are having some income in India, and whatever incomes are coming in India, so you will be liable to pay tax on that part, and this will be it. This will be applicable, as I said earlier, to all HF also, AOP, association person also, and body of individual jurisdiction. So you must look into this aspect. HF by and large do not have much income except business income. By and large, they have interest income or rental income. And probably, in my opinion, probably HF, the old scheme may still be better because this rebate of what we call 25,000 will not be available on this part, on this issue. Another change which may be relevant and important I may mention is regarding the premium being paid on the life insurance policies. Some years back, government has made an amendment that benefit of exempt income on redemption of or maturity of the insurance policy will be available only when the contribution per year, premium per year is not more than 25% of the assured sum. Few years back, it was reduced to 10 years. Now, in this budget, it has been proposed in the additional condition that not only the premium should not exceed 10% in any of the years of the life of the insurance policy of the sum assured, but in addition thereto, there will be another condition that the premium paid during the year on any policy should not exceed rupees 5 lakh. And in case one has a more than one policy, then aggregate of the premium should not exceed of any policy more than 5 lakh rupees. So this is the idea. They want to restrict. They say, don't use this money of insurance as an investment. And that's why they say this exemption under section 1010D on maturity will not be available when the policy get matured or redeemed, but will be available in case some contingency happen, meaning thereby in the case of a death of the person, so whatever amount it will be received, howsoever big the policy may be, that benefit will be available. This new condition will be applicable in respect of the insurance policies issued on or after 1st April 2023. So all policies shall still be continued to be governed by the old law, that the premium can still be more than 5 lakh rupees, but only a new policy after 1st April 2023 shall not be eligible on that point. When I'm talking about the tax rate, there's a small change which probably may not be relevant. I will just go through it. Cooperative societies have also now being allowed that they can go for a manufacturing, and in case they go for manufacturing, the tax rate will be 15%. As you know, in 1st September 19 onward, any company incorporated after that date and going for manufacturing, the it can opt for a lower rate of tax, which is 15%, and that benefit is being extended to now to cooperative society, with the condition that a society should be registered on or after 1st April 23, and it should come into manufacturing before 31st March 24. This looks to be a good welcome change, but the period given to cooperative society is too short. In India, we have very sugar cooperative mills. We're working across India, particularly large number of cooperative mills working in Maharashtra. My only condition worry is that period for getting registered and getting into manufacturing, 1 year is too short. I believe this has been, I think, aligned with the period which is allowed to the companies. But the company's period was started from 19 to 24, 5 years was quite a good period. But for a cooperative society, I believe this period is going to be a challenge, and somewhere this problem can be there on this issue. Now, 2-3 issues which I will just try to touch upon on business, then I can go to some issue which may be of interest to you. One that issue, probably MSME issue you would have heard is that now this deduction will be allowed only when you have made the actual payment. My only apprehension is probably this may be not so productive or so helpful for the sector for which we are talking about it, because the tax liability in case of non-payment on the person, maybe because of the late payment being received from the customer, will be too high to bear with it. So I can leave this topic here only. And then similarly, 28.4, there is some change which has been made where probably all those companies, all those corporate or those entities which settle the bank account, and there is a settlement and there is a huge haircut, they may be required to pay tax on the difference of the amount, what they were supposed to pay and what they are actually paying on this bank. For your interest, the most important, I think, will be what the amendment which has been made to section 56(2)(7)(b). You all know that India is looking for investment abroad, etc. But here is a rule, there is a rule which says a company which receives share capital and issue share to its shareholders, the value at which the shares are issued should not be more than the fair market value. Take a case, there is a company A, now it wants to issue a fresh issue of the capital or FPO or whatever it is, unlisted of course, unlisted. For listed company, there is no such rule. For a unlisted company, if we want to issue a share, it cannot issue share at a premium with the value, total value, fair is more than the fair market value. And in case it issues at a value more than that, then the difference is deemed to be the income of the company. Now, this was applicable when the shares were being issued to a resident owner. Now, this finance bill proposes that even when you issue share to a non-resident, even then the difference between the fair market value and the value at which you have issued the share will be deemed to be the income of the company. Now, here there will be a catch-22 position. Under the RBI FEMA rules, you cannot issue share at a value less than the fair market value. And under the income tax law, you cannot issue share at a value more than the fair market value. So now the absolutely clear line, demarcated line has to be drawn that my fair market value. And it is very difficult to determine the fair market value of a running company, though there are methods are prescribed, net asset value method, discounted cash flow method. These are the methods which have been prescribed. But the challenge will be that how to convince the assessing officer that the value which you have worked out is the correct value. Though there are exemptions from this provision to a startup industry or when there is a venture capital fund, but I believe India is getting a lot of investment in the existing running company from the PE, which may be coming from the UAE, which may be coming from Oman, which may be coming from Mauritius, Netherlands, etc. And when these capital shares are being issued, the value of the share is quite high as compared to the net asset value method. In the case where these shares are being issued at a premium, there's every possibility that one may run into difficulty and the challenge may come up on that issue point of view. So I think that's a challenge which may come. Now, my suggestion to all of you, you being a non-resident, and if you're making investment in any unlisted company, please make sure that the investment you make is not at a value which is more than the fair market value of the share of that company, because otherwise that difference is not in your hand, but in the hand of the company will receive capital. will become taxable to tax. Another change important is in India, a gift by a resident to non-resident is a resident to another resident is chargeable to tax, and it is considered to be income from other sources. Now the question is the reason that why not to tax it? So 3 years back, a gift from resident to non-resident was also made taxable in the hand of a non-resident. Because in the case of a non-resident, only income which accrues and arises in India is liable to tax. But the new look into the fact that the gift to a non-resident can be a tax saving device, a deeming fiction has been created whereby any gift made by a resident to a non-resident shall be deemed to accrue and arise in India. Now the provision is being widened to include gift by resident to resident, but not ordinary resident also. So as you all know that after being a non-resident for 9 years, you can, when you return back to India, your status is of RNOR, resident, but not ordinary resident. So now that benefit during that period, if you receive any gift, that will also become chargeable tax. I hope you're all aware that in case you receive any gift from a resident, then you will be liable. Just take a case. I believe there have been cases where under LRS in India, up to $250,000 are allowed to be remitted by any resident to any person outside. Now, in case any Indian sends a money outside India to a person who is not falling within the definition of the relative definition is given under the Act, and that money comes to your account, now you are liable to pay tax in India on that. So while getting money from India, I think the normally the channel is reversed. Money comes from Muscat, Oman to India rather than going from India to Muscat or Oman. I believe that way. But still make sure that in case you receive money, unless that person is coming within the definition of relative, whatever the money you are receiving here, you may be liable to pay tax in India on that aspect, on that issue. There's another interesting aspect on LRS, which probably not applicable to non-resident, but is applicable to resident, and you need to take care because your relatives must be coming and doing all this. Now, under the law income tax, when a payment is remitted outside India, it is liable for tax collection at source. This provision was inserted to keep a track of the payment being remitted outside India by the taxpayers. And the tax rate was 0.5% and 5%. That was the rate. If one remits the money for education of the children abroad, then TCS was 0.5% in case you have taken a bank loan or financial institution. For health purposes, medical, then it was 5% with a threshold of 7 lakh rupees. If you are remitting to tour operators, then it was 5% with a no threshold. And if you are remitting money under LRS, then it was again 5% with no threshold, with threshold of 7 lakh rupees. Now there is a steep increase from 5 to 20%. If you are remitting money to a tour operators outside for visiting, traveling, then there will be a collection of tax at 20%. Similarly, for LRS, it will be 20%. Just take a case, as I said, Muscat is the third beautiful city of the world. And some of your friend or some other person wants to buy a home or house in Muscat. And under the LRS, he can remit $2.5 lakh, which comes to somewhere 2 crore rupees. And he finds a house and you say, all right, here you can get a good house here. And the cost is somewhere say $4 lakh, which comes $4 or $5 lakh. Wife and husband both send the money here and buy the house. But while sending the money now, if $2.5 lakh, 2 crore, and 2 crore is 20% extra will have to be paid to the bank as a tax collection, which will be refunded later on. Now, this is a big challenge which will come up cash flow, because what is being remitted outside is a application of income, not accumulated of income. This is not an extra accrued income. This is an application of income on which already tax has been paid. So there will be a challenge on this aspect also. And I believe that can be I think a big challenge. How this 20% is being worked out is again an issue which needs some retrospection and need to be looked into again on that part. When we are talking of the house on this issue, some of you, I think, are having residential house in India, and some of you intend to buy residential house after selling some of the investment you have made in India, maybe a residential house or other. Earlier, there was no restriction of the value of the house you wanted to purchase, and capital gain was fully exempt on that issue. Now, a restriction has been placed that in case you sell a house or you sell any other investment to buy a house, then the exemption available will be restricted to how value of the new house of rupees 10 crore only. I just can give an example. If you have a house in India where you have present cost is 1 crore rupees, index cost is say 2 crore rupees, and you are selling that house for 20 crore rupees, you make a capital gain of 18 crore rupees. Earlier, if you have bought a house for 18 crore rupees, there was no tax. Now, under the proposed law, if you sell that house for 20 crore and you buy a 18 crore rupees house, you will be required to pay tax on 8 crore, as exemption will be limited to 10 crores. Similarly, when you have investment in shares or securities or bond, etc., now that benefit will also be restricted, considering that the 10 crore rupees is the value of the new house. I hope you are aware of the provision that under section 54, it is a capital gain which is exempt, and in 54F, it is the net consideration which you have to apply on that part also. So this is the change which has been affected on that part on issues. Now I can just take you back to some of the issue which may be relevant to the what we call, but in the context of the Oman issue. Can you go to the next slide? Now this is something which I would just like to take. What is the position? How it is going to affect? Now India and Oman has a tax treaty, so which says residential status is to be determined as per the domestic law of the contracting state, India and Oman respectively. Under the Indian law, if you have been in India for 182 days or more, then you are considered to be a resident of India. Next. Next. And under the Oman law, a natural person will be a resident if he or she spend 183 days or more consecutive interval in Oman during the tax year. So this is the position, I believe. I hope I am correct on that position. That if one has been in Oman for 183 days, you are a resident on India. Next. Now, in case there is a situation that one become a resident of both countries, then the tiebreaker rule is applicable. So that may not be required. I have to understand here. Can you go next? Next. Now, this is also explained very important. Now, this is important. Under the India-Oman double taxation treaty, there are 3 benefits which have been given. One is Article 11, dividend, Article 12, interest, and Article 15 is the capital gain. Can we go to Article 11? You have the Article 11 here?
They've covered it out. You can just.
Now, under Article 11, if I am correct on that part, under DTAA, dividend income in the hands of a non-resident under the treaty will be chargeable at the rate of 10% if the person is holding more than 10% equity in the company, and 12.5% if it is less than 10% of that issues. There is no surcharge, etc. So meaning thereby, whatever investments you are making in India, now the dividend is chargeable to tax in your hand at 12.5% in India. This is the benefit of the resident being a non-resident. Next. Now, similarly, interest income, which is normally chargeable at a higher rate at India at 20%, and dividend is chargeable at a normal rate. Now, under the treaty, it is 10% when the benefit is available to 10%. Next. Now, capital gain, I will come to later on. Now, this budget has made an amendment. Can you go back to the next slide? Now, this was the amendment which was made last year when the dividend was made taxable in the hand of the individual. So now, on being shown TRC, you are all maybe having tax resident certificate of the Oman. So on that basis, your dividend income is chargeable to tax at 12.5% in India. That's the basis, which is the lower of the tax, which is working it out. Similarly, interest income in India is chargeable to tax%. Now, there was a clause. Can you go to section 196(1)(a)? This budget has proposed an amendment in section 196(1)(a), whereby, can you take off the slide?
So they do affect like the value inserted in
No, can't be so.
this.
Can you take off the presentation?
Okay.
Now, under the Indian tax law, tax is to be deducted at the rate of 20% on while making payment of income on mutual funds and dividend income also. Now, there was a complexity on this issue, and there was a Supreme Court judgment which has come in the case of Pilcom, saying that in case the Indian tax law provide a higher TDS rate, that will be applicable, and the person non-resident need to file the tax return and claim a refund. Now, this finance bill has proposed to remove this anomaly to clarify that now under section 196(1)(a), any income from mutual fund which is subject to 20% will be subject to further DTAA, and in case the rate of DTAA is lower than the 20%, that rate will be applicable. I believe that DTAA between India and Oman carries a rate of what we call 12.5%. So now income from mutual fund which you have made invested in India, now the TDS rate applicable will be 12.5% on that also. I hope that now that position will get improved on that part also. So this is the benefit which will come under the treaty benefit India-Oman treaty. Now there is another provision which probably you may be aware of this, because India-Oman treaty is one very peculiar treaty on that part. If you can just look at the capital gain provision, can just go into the slides. Next. Now, this is the provision of capital gain. Now, capital gain provision with India-Oman clearly says that capital gain will be chargeable to tax in case of immovable property where the property is situated. In the case of a company where the company property is the main asset, then it will be that asset situated, and share where the company is registered like in India. But in other cases, it will be only in the country in which the person is a resident. So this is a unique clause, because in your case, it is only the other than share and immovable properties, only that income can be charged in India, which is arising in India, but not in your head because you are non-resident. And India-Oman treaty has a special clause. Can you go to double taxation avoidance agreement? Next. This clause is very important, and this is a unique clause which is rarely in 2-3 treaties. It was with Thailand treaty, which has been deleted, but now the tax payable in a contracting state mentioned in paragraph 2 and these shall be deemed to include the tax which would have been payable but for the tax incentive granted in the laws of the contracting state. So meaning thereby, in case somebody is having a business in Oman, and in Oman, because of the tax incentive provided, that income is exempt. Now, to the extent that tax would have been payable in Oman, in India, you can get a credit. Similarly, if a person is operating in India and that income is exempt like power sector, etc., and that person need not pay tax in Oman to the extent the tax has been saved in India. This is, I believe, a very unique treaty benefit on that part, aspect on that part issue. And there are some other changes regarding the non-resident. Particularly, you will see that India has a gift city in Gujarat, Ahmedabad. We have a gift city on that part. Now, in gift city, when one person shifts from a non-gift city to gift city, entire capital gain is exempt. And now also this is an opportunity for non-resident to operate and do business or to make investment through gift city. So whatever you earn there in gift city will be exempt and not taxable in India, because India is taking that gift city as a separate, whatever you call as a separate free zone treaty on that part. So that's another advantage which has come out on this issue. Then there are certain provisions which I believe may not be of much of interest. There are benefit of regarding REITs, InvIT, etc. Probably I think may not be of much of your interest as a non-resident Indian. And another one maybe some interesting maybe online gaming. So online gaming can be done from anywhere, sitting in any part of the world. And there have been confusion in India whether how to tax this online gaming and what should be taxed. Now this finance bill has proposed that any net online winning, net proceed will be chargeable to tax at a special rate of 30%. So there is no threshold available. So the straight away, the rate applicable will be 30% straight away. One has to pay the tax on 30% straight away. And for how to compute it, for that there will be a rule which will be notified soon, and working, I believe, will be worked out on that basis. But the online gaming, the procedure has been now streamlined, and that will make the life easier for that part only. Another thing which may be, I believe you may be interested, and probably you may be making investment in market-linked debentures. There is a market-linked debenture which are called debenture, but the rate of return what they get is linked to the derivatives which they are receiving. Now the Government of India, its thought process is, though apparently it looks to be a debt instrument, but it apparently is not so debt. And that's why they say now that there will be no concession available to it. Any profit arising on market-linked debenture will be considered to be a short-term capital gain and will be chargeable at a normal rate. A normal rate will be 30%. And in line with that, there was an exemption not to deduct tax at source on this type of instrument under Section 193. Now that exemption is also being withdrawn. So in case you are holding any investment in market-linked debenture from 1st April 2023 onwards, now that exemption will not be available. It will be considered to be a short-term capital gain liable for tax at the normal rate, and you will be required, and tax will be also be required to be deducted at source on that part also on this issue. Then there are some provisions regarding 44BB and 44BBB. I believe these provisions are for presumptive model of taxation in respect of oil drilling, etc. I believe many of the risks may be coming from that part of the world on that part. So that provision is also being amended now, and we clarified that in case one is going for this presumptive model of taxation, then the benefit of carry forward losses and unabsorbed appreciation will not be available. I believe this is only to safeguard that one does not switch over from one process to another process. So that's why this provision has been introduced on that part. Friends, I believe these are the major amendments which have been made. This another amendment which may not be so, I think, applicable, but just to make it clear, maybe applicable. You all know that now India has a process of what we call a tax audit. But for the case of a small business and small professional, there is a presumptive model of taxation. If you have a turnover up to rupees 2 crore, then you need not maintain a books of account, and you have to pay tax at a fixed percentage, which is 8%, but concessional 6% if you payments are by checks. Similarly, for a small professional up to turnover of 50 lakh rupees, there is a presumptive model that it will be tax will be 50% will be considered, and you are not required to maintain books of account, or you don't get audit. Now that threshold is being increased from 2 crore to 3 crore in case of a business, and in case of a profession from 50 lakh to 75 lakh rupees. So if you happen to be doing any professional here in India, etc., so this benefit will be available, that 50% will be there. And then another benefit available will be that tax in the case of business will be applicable at the rate of 6%. The only condition is that 95% of your receipts or turnover should be by account paid checks only, not by cash or by otherwise bearer checks or cross check, etc. I believe this is a biggest bonanza which has been given to the business. Look at the figure of 3 crore rupees. If I look into the number, I believe all you understand in rupees, not in dollar, maybe. Now 3 crore rupees. If 3 crore rupees is the income, turnover, and 6% is the deemed income, so my income will be 18 lakh rupees. On 18 lakh rupees under the new regime, without any deduction, without any exemption, the tax liability will be just 3 lakh rupees, which will be just 1% of the 3 crore rupees on paid tax on them. On 3 crore, I pay 3 lakh rupee tax, 1%. And just imagine what does this mean, 3 crore? 3 crore means 1 lakh rupees per day turnover if I exclude 52 Sundays and some Diwali or festival holidays, etc. So 1 lakh rupees per day you have a turnover, and then you still just pay 3 lakh rupees, just 1% of your income as your income tax. That's the ease of doing business which India has projected, and the ease of working which is there. Similarly, I believe there are many amendments which have been proposed in this budget, and the whole target is that to make that Indian economy moving and running fast. And that's why I have not touched upon those. There are some other economic issues to give speed to the economy, to give speed to the infrastructure and working. A lot of schemes have been announced, which means Vande Bharat, we say the trains which we are working it out, and the speed and the metro which we are working it on the issue. And then India looking forward to be the substitute to the China because of the new geopolitical situation as a global capital of manufacturing. I believe you being all non-resident and being there as a real ambassador of India, I think you can help India, or you can work for that, that looking to this, the way India is looking, that our economy is growing, we have economic stability, we have a political stability, and we have the best of infrastructure. So and the best of regulator. That's why there's all the need that we need the support from the world over, that they should look forward and make investment. I normally say that some people ask me whether people will like to take a risk to invest in India. I pose a question. The way Indian economy is growing, any person who is interested in making money can afford to not to make investment in India. That's the scenario in India. With this, my thanks to all. We can just open it for question and answer. If there's any subject which you like to cover, I would like to cover upon this issue.
Thank you, sir, for your detailed presentation. You touched upon a lot of topics. You started from economic survey. We covered GDP, inflation, tax collection, capex, and there were a lot of confusion, as you rightly said, on old regime and new regime in income tax. And special thanks to you for covering non-resident part separately, and that too double taxation with Oman and India. So we have received few questions. I'll take sequentially. Also, there is a request for the attendees to mention the question in the question and answer. We'll take it up if the time permits. So we'll start with the first question. First question is from Mukesh Darji. He's asking, government should not push for new tax regime which discourages investment and so saving. This is more concerning when there is no formal social security benefit on retirement. Don't you think long term it would lead to scarcity of capital and investments required for development? So his question is, why government is pushing for new tax regime which discourages investments?
I believe I touched upon this issue while I was discussing this point about the social security. The compulsion of the government in pushing the new regime is, though it is being said that we don't want any exemption and deduction, probably the idea is that how to give a speed to the Indian economy. If we make more money available in the hands of a taxpayer, probably he will have more options to buy and to go spend money. So give a speed to the economy. If savings are increased, probably that money does not circulate. The best of a model, which I have seen mostly in the developed nation, is that the economy rotates very fast during the day itself. I was away in Toronto, and I can just say the model what it is. People go to government offices in the morning at 8 o'clock and work say up to 12. After 12, they go to the market, whatever they have earned, and they buy shop clothes or something like this. And the shopkeeper who have sold the good between 12 to 4, they go into 4 to 8 various hotel, restaurant, etc. They spend the money. So money get rotated very fast. Nobody is interested in saving. So India now, I think, is looking that instead that people to encourage for saving, let's go for this, what we call spending the money, economy can get a propulsion. But as I said, and rightly said by Mr. Mukesh, there is a challenge that Indian taxpayer will now find that at the time of retirement or old age or difficult time, there will be no money to fall back upon. I believe this scheme of ATC or ATD, medical, housing, etc. These are all social security, because government believe that, I am of the view that for a 140 crore population, it is impossible for the government to provide social security to all. It can only encourage people to take a social security. Now the fallout, I believe, biggest will be two challenges the LIC will face. Now the biggest institution, 80C having become optional. Now people will not be buying insurance policy, which we normally see in January, February, March, people buying policy. So all those people go. And then the cap of 5 lakh rupees during a premium, I believe even HNI who were making investment, they will also go back. So that LIC will also be in problem. And you have rightly said that many of the taxpayers not going for social security will also be a problem. And to support what Mr. Mukesh has said, his argument that why we under the labor law, there is a condition that every employer will deduct PF and deposit it. The purpose is part of the salary get deducted and equal contribution comes from the employer. The reason is only this, that you want to create a social security. Even for a government servant, the government says that I will deduct PF, I will deduct pension fund also, and I will create a pension for you. When you retire, you will get a pension out of this. But then why not a self-employed person or a taxpayer should not be encouraged to create a social security? I believe Mr. Mukesh is right, but the government policies, everyone has to bear with it. And now the government is thinking that let's go to the, but we'll get exemption-less regime. That's a view. I believe that's the issue.
Thank you, sir. I think the share market on the day of budget was very volatile. First it was up, then down, but all insurance companies were down by 10%. So I think the mindset of Indians, that is to consider insurance for protection and not only for tax saving, needs to change. But that clearly reflects on the share prices of insurance companies.
I know. That's correct. Yeah.
We'll take second question, that is from Pankaj Kumar. That is on TRC. Single TRC from Oman Tax Authority. Will this work in all institutions from India where we have received income, or we have to take separate TRC for each Indian institution? Is there a separate TRC or consolidated?
I believe one TRC will do. Once you get a certificate from the tax agent certificate, that will do. And this is now important from Indian perspective. I believe under India-Oman Treaty, there is a lot of advantage to resident of Oman. There's a lot of benefit. And my suggestion will be, as I said, is that the moment you have a TRC, you can get all the advantage of this issue. Since today my presentation was only, I was trying to correlate only with the amendment proposed in the finance bill. So I have done a program, similar program, when the 2 years back for the Dubai chapter, our non-resident Indian. So in that, I have just said that what benefit you get as non-resident Indian is tremendous. Only thing is that you must be very clear that you become a resident of particular country. After India amending the law about the citizenship, and that way a person citizenless, what we call you are not a citizen of any country. Now this has become more and more important that you have a TRC of Oman. That's the issue.
Thank you, sir. Next from Mr. Rajiv Shah. His question is on dividend withholding, that is TDS of 20% on dividend paid to NRIs. This is now reduced to 12.5%. However, will NRI have to submit the TRC to all dividend paying listed companies he has invested in? That is separate TRC for each company is a costly and time consuming affair. Obviously.
I believe once you have taken a TRC, at the time when a dividend is declared by the company, an intimation comes to the shareholder to fill in the form and make a declaration. Based on that, one can do it and file a TRC, and that should do. It is not that you should obtain a TRC for each of the company. TRC is not issued in the name of the company. TRC is issued in the name of the taxpayer.
Yeah. We started this session with saving and insurance. This is, I believe, the last question. That is again on insurance. It's a bit detailed question. It's anonymous attendee. I request the person who has raised the question to raise a hand, please, so that we will know. If a person has existing life policy prior to 31st March 23, where premium is 5 lakh per annum, if such person takes another policy after 31st March 23, where premium is rupees 3 lakhs per annum, will income from the second policy, that is the policy taken after March 23, will be liable to tax? That is, will premium of policies issued prior to March 23 be added while totaling annual premium?
It's a very interesting question, and that shows the fertile mind of chartered accountants. I must compliment the gentleman that how the question is to be posed and make difficult. But answer will be, I believe I will correct. Aggregate of the amount of the insurance policy, this 3 lakh will get excluded immediately, because though it is applicable in respect of policy issued on or after 1st April 2023, but while aggregating it, then your 5 lakh is already crossed, so this 3 lakh will be over and above that, so that will get hit. So this policy having been issued, had he been taken 8 lakh rupees policy before 31st March 23, he could have continued. But any policy over and above 5 lakh now that will get hit, because that is a policy issued on or after 1st April 23.
We have just received one more question, that is on subsidies. The budget has not provided anything on restricting the subsidies on food, fertilizer, fuel, etc., which is taking much of budget expenditure. What are your views on subsidies? I joked that poor gets the subsidy, CA gets the debate. So what are your views on subsidies?
See, there are 2 reasons we must appreciate. To live in a society peacefully and comfortably, one need to make sure that your neighbor is also does not go to the bed without food. So in case people go without food, your life will be difficult and you will be insecure. Out of 140 crore population, there are at least, if not more than 25 to 30 crore people which are below the poverty line. And their income, as we know, I need not say what is the stature there. So food subsidy is an important aspect as a social security. And the reasons are obvious. And I have not touched upon charitable trusts or institutions. There are so many amendments. I thought you may not be interested. I being non-resident of them. So I try to cover up those areas which may, as a non-resident, may be of interest to you. Otherwise, this budget has 122 clauses, and I can speak for 3 hours on this issue. Even I have spent 1 minute on one particular issue. Now, on food subsidy, see, fertilizer subsidy is given to the farmers. And the reason why fertilizer subsidy is given to the farmer is that the income of the farmer is not of that level he can sustain. And one of the reasons why income is not going up is restriction on the farmer not to sell the food, not to export them. Now take what has happened. Ukraine crisis happened. Wheat prices have gone up like globally skyrocketing. Indian farmers were not allowed to export wheat because then India will have a scarcity. So you are regulating the selling price of the gentleman. And now you say, no, I will not give a subsidy to fertilizer on that part. Secondly, if you look at, if I just share a data about the farmer's plight, when India got freedom in 1947, we were a country of 33 crore population with 60% of the population in farming depending on agriculture, which means 20 crore population were dependent on agriculture. And we were having 15.5 lakh hectare land. Now today with 140 crore population, I believe 55% population is dependent on agriculture, which takes a number to somewhere 70 crore population, if I take a conservative figure, on agriculture. And area under cultivation has increased just 10% from 15.5 to somewhere 16.5 lakh hectare. Now, when 15.5 lakh hectare was feeding 20 crore population, now 16.5 lakh hectare is feeding 70 crore population. Just imagine what income poor people will be having. So now in a healthy, I think a country which is what we call socialist and which is looking to take care, I believe you need to provide support to these people. Only thing which we need to make sure that subsidy reaches to the right person and right people. That's the issue. And all these 3 subsidies, I believe there are 3 subsidies we are talking about, I believe. Are meant, there's no subsidy now on petroleum by and large, subsidies on food and mainly on fertilizer. And this year, fertilizer subsidy figure has gone up in the budget. I didn't touch up minutely, but I look into that aspect also, mainly because crude oil prices have gone up. Fertilizers, a major component raw material is this crude oil, and those prices due to Ukraine war has gone up, and that's why this fertilizer subsidy has also gone up on that.
Thank you, sir. I agree with your comments, because it's not every time they are increasing the subsidy. If you look at kerosene subsidy, it has been decreasing. So government has been taking right steps to give subsidy only where it is required. In fact, there was a campaign to give up the subsidy on our cooking gas also. So I think it's on the right track. We'll take the last question for
I believe we have to clarify that Mr. Rajiv Shah has just asked one question.
Yeah.
TRC from Aman is issued with the name of the dividend paying company, does not issue TRC as a whomsoever. So if that be the case, I believe then you have to write to the tax authority giving a list of the name of the company in one go. I believe in India we have a system like this also. When you want to go obtain a lower deduction tax certificate, it is issued in the name of the deductor, and then you give a list and they enclose the list of the person. So what you can do is, if that be the situation, then you apply to your tax department that these are the company where I'm holding investment, please issue a TRC. So they will address it to all the companies in one go and issue a certificate to reduce the cost, I believe.
Thank you, sir. And the last question on the budget deficit. When I was studying for CA Foundation, I started going through the nitty-gritties of budget. I was always wondering why every budget is in deficit. Why can't they make it in surplus? But then as you start studying for CA, you realize the meaning of deficit, the welfare and those things. So the last question for the day is, borrowings have been increasing year on year to bridge the fiscal deficit. And it is much more than what has been prescribed in FRMB Act. So your views on this, please, sir.
Just before I answer that question, let me just clarify on the TRC also. There is a requirement to upload Form 10F, file Form 10F also for TRC purposes. So just look into that aspect. There is a prescribed Form 10F for the purpose. Now, to answer this question, you have raised very important and interesting issue, because it is not tax, it is a basically economic issues. There are 2-3 things which we must try to appreciate. What is fiscal deficit? Why there is fiscal deficit? Now take a case. I have 10 lakh rupees in my pocket and I want to set up a business. I have one option to do business with 10 lakh rupees and make my earning whatever 10%, 12% earning. That will be good. Now, in case I want to increase my business, somebody will say, why don't you go to the bank? I say, I can go to the bank. And the bank will say, okay, I will give you loan. Say you have a capital of 10 lakh rupees, I can give you a loan of 20 lakh rupees. And then my arithmetic will be, bank is charging 8% if I borrow at 20 lakh rupees, and I can make say 12% on this. So my income will go up. Now on 10 lakh, if I earn 12%, it is 1,20,000 rupees. With 30 lakh rupees, I earn 3,60,000 rupees. On 20 lakh rupees, I pay 8% interest, which is 1,60,000. So I make 2 lakh rupees on my 10 lakh rupees. My rate of return goes to 20% immediately. I hope you are able to understand my calculation. Exactly same thing applies to a developing nation. If we have to grow, we have to provide facilities. We have to create capital. We have to create infrastructure, etc. So sometimes it looks like that fiscal deficit is a very bad thing. Even if you look at the FRBM accepts the fiscal deficit in how it has to be worked out, and it says up to 4% it is a workable. Why so? When you eat food without salt, it will not be tastier. You have to mix it, put a salt in your food, so to make it tastier. Similarly, if you want to make your economy grow and multiply accelerator, you have to have a fiscal deficit. Otherwise, the economy will never expand. You have to give a boost to the economy and give a jump to the economy, the fiscal deficit. But the challenge is that in case the fiscal deficit increases beyond a point, the way if you put more salt, your food will bitter. Similarly, your economy will go out of your hand. So fiscal deficit is an accelerator, what we call in science catalyst, to give boost to the economy, to give an accelerator to the economy. I hope some of students, maybe I have been a science graduate, I know what is meaning of a catalyst. Catalyst does not do anything itself, but it accelerates the reactions fast. So fiscal deficit, in fact, accelerate the reaction of the economy to grow much faster. Only thing is that you must be in control, keep it a control and should not go. Look at the India's number. Before 2021-20, when we had a COVID, India fiscal deficit was hovering around 4 to 4.5%. Because of the COVID happening in the 21, we were having a fiscal deficit of more than 8%, 7-8% we reached it. And the world's developed nation reached 10%, 12%. So we were having. Now in the year we have projected a fiscal deficit of 5.9%. 5.9%. And this fiscal deficit of 5.9%, if you will just wonder, we are going to borrow somewhere 18 lakh crore rupees, and our total GDP is 300 lakh crore, which is just 300 lakh crore. If you look at the projected 300, if you look at the budget document, you will find out that our total GDP projected next year is 301 lakh. And our total borrowings are expected to be 18 lakh crore. And this works out to be somewhere 5.9% of our total GDP. And with a commitment that within a period of 2 years, it will go down below somewhere 4.5% of our income. That's a commitment which has come. This is good. And when you are interested in numbers, I will just share the total liability of India. As on 31st March 23, the total debt, Indian government debt is, as per the document shared in the budget, is 153 lakh crore. 153 lakh crore, which is supposed to go to 172 lakh crore by 2024, by increasing by 18 lakh rupees, which is, if you calculate in percentage, we are all accountant of 300 lakh crore my GDP. 60% of the total GDP is the outstanding debt on that part. So I do appreciate that fiscal deficit should be minimum, but don't consider that it is a very bad thing. It is like a salt in the food. You need to have some taste of it, but don't put so much salt that your food becomes bitter. Keep it tastier. So that is the idea one must keep in mind on that part. I believe that's the idea objective.
Thank you, sir. Thanks for your detailed answer. May I request CA Shilpa to felicitate Jain Saab and also a formal vote of thanks, please.
Thank you, CA Ashish. I hope you can hear me.
Yes, yeah, we can hear you.
Yes, okay. I couldn't see you, so I'm glad that they put you on spotlight. Thank you so much. With the sincere gratitude, we present you this certificate of appreciation for this excellent session on Indian budget. Please accept this on our behalf. We will email this to you, sir.
Thanks a lot. Thank you, Shilpaji. It has been a great pleasure to be part of this to be here in Muscat chapter. And again, heartiest congratulations for winning this second best chapter prize. And I believe the chapter is doing a wonderful job and continue to work in the mission in which you are doing. As I said in the beginning, you are the torchbearer. You are carrying the, I believe, you are the real ambassador of our profession. And today also I was addressing it during the day. Some of the students, I have gone for a program on the DD News. So there was some student program I was addressing therein, that some students were there. I said that once you become a chartered accountant, you have a complete insurance of your life, best of luxury, best of everything you will get. All you have to do is pass this chartered accountancy examination. All you being a chartered accountant, you are doing a wonderful job and continue to do. It has been a pleasure for me. Thanks a lot. Thank you.
Thank you for your kind words, sir. I'm having goosebumps. It's a feeling of pride to be representing our CA fraternity here in Oman. Thank you for your kind words. Now I go forward and do the formal vote of thanks. On behalf of the Muscat chapter of ICAI, I would like to extend our sincere gratitude to you, CA Ved Jain, for this insightful and informative talk on the Indian budget 2023. We appreciate your tailored approach to the NRIs living in Oman, with respect to the DTA with Oman, and thus it affects us directly. So thank you for doing that for us. We feel greatly honored by your presence. We hope to have you here in person soon in the third beautiful city in the world, sir. I also extend a big thank you to our sponsor, CBFS, for their unstinted support in all our endeavors. Thank you to CA Ashish Subedar for being such a great MC for the day. Thank you to all the MC members who helped make this event a grand success. I would also like to take this opportunity to place on record our sincere thanks to all our corporate supporters, corporate members, and not last but not the least, all our members for actively participating in all our events and for your constant encouragement. Our award as one of the best chapters is a testament to your involvement and support. With this, I sign off with an immense gratitude to one and all. All of you have a great little bit of weekend that we have left. And thank you so much for being here. We had such a big presence here today, CA Ved Jain. We had, I think at one point, I saw about 80 attendees, 80, 90 attendees. So it's one of our, I could call it a hit, our Pathan hit.
But good.
We have some, I think few members have raised their hands, so maybe we'll ask them to.
Yeah, it's me, Umesh.
Yeah, Gopalji.
Just need
Turn
to
on
have
your video,
a small
Gopalji.
request. Can we have Shri Ved Jain, sir, as one of the persons who can come one day for a CP event or something like that in Muscat?
Still
And that's what I said. We would really
Let
love
me
to
plan
have.
it out. I will be my player. No issue that. I will plan it out. No issue that.
No, you're such a prolific speaker as far as direct taxes is concerned. So you can just come for some time, maybe for a day or so, and then talk on the Indian taxonomy and Indian direct taxes related aspects.
Definitely, I will do. Definitely, I will plan it out. No issue.
Thank you.
Thank you.
Mr. Vijay Kumar Pai, you can unmute. I think he's not there. Any other member wants to share his views, ask questions?
Also, Umesh, this particular PPT which sir was presenting today, can I make a request that he can send it to you and you can distribute it to all the members who attended that today through email?
I will just send it across to WhatsApp to Mr. Umesh, and then he can circulate it. No issue there.
Thank you very much, sir. Thank you very much.
Okay, thank you, everybody.
Thank you.
Thank you.
Okay, so we sign off.
Yeah, thank you.
Thank you, sir. Thank you very much.
Thank you, everyone. Thank you very much.